Hi, welcome to the navigation. Today we are going to learn about price to book ratio. We have already seen the price to earnings ratio and earnings yield. Today we are going to learn price to book ratio. Coming to the formula, price to book ratio is nothing but market price of the share divided by the book value per share. The book value is nothing but the asset value of the company on the documents. How to calculate this book value? The book value per share generally calculated by this formula: total assets minus liabilities by outstanding shares. The general relation between the assets, liabilities and owner equity is this one. If the PB ratio is less than 1, means what it tells is market price of the share is less than the asset value of the company per share. So if it is less than 1, means the share is undervalued stock. If the price to book ratio is greater than 1, means the market price per share is greater than the book value, actual value of the company. It tells that the stock is overvalued. Sometimes we will observe the higher stock price. This is due to the whatever the positive things of the company that are already implemented in the stock price. As a result, the higher share prices we observe. And next, coming to the relation between return on equity and PB ratio. Most of the times PB ratio used in conjunction with return on equity. The formula for return on equity is nothing but net income or net profit by the shareholders equity, and ROE is also a good reliable indicator. A high PB ratio with low return on equity usually tells that the stock is overvalued, and a low PB value and with high ROE indicates a undervalued stock. Next, coming to the limitations. PB ratio mostly useful for the capital intensive businesses. That means the sector which are having the more assets in their balance sheet, such as energy, transportation and finance. Book value ignores intangible assets such as brand name, patents and other intellectual properties. Suppose if the Google asset value is determined by its intellectual property rather than its physical property. Companies that are having high debt or sustained losses are also gives wrong PB values. And highly leveraged companies such as electricity, wireless, telecommunication companies always having the high debts. For companies having losses, book value can be negative, hence it is meaningless. Now we will see one example of PB ratio. Suppose let's say a company has assets of 1 crore, liabilities which might be short term or long run 75 lakhs, outstanding shares are 10 lakhs, stock price is 5. Then the book value is of the company is the asset value of the company is 25 lakhs. Then book value per share is calculated by this formula, which is 2.50, and the PB ratio is 2. It means the stock price is 2 times higher than the actual company asset value. Suppose if the PB ratio is negative, what it tells? A negative PB ratio tells that the company more liabilities than assets. However, this is always not a bad news for the some of the sectors. Thank you.